Moody's has just made history by stripping the United States of its top-notch AAA credit rating. This downgrade is more than just a symbolic blow, it's a reflection of deepening concerns about America's rising debt levels and widening budget deficit. Cut to visuals of Moody's building, US Treasury, and debt statistics overlaying the screen. Host: on Friday, the credit rating agency slashed the US's rating by one notch from AAA to AA1, shifting its outlook to stable from negative. This puts the US alongside countries like Belgium and the Czech Republic, nations not typically seen as economic powerhouses like America. Moody's decision comes at a time when President Donald Trump and his Republican Party are pushing for a budget bill that is expected to balloon the national debt even further. Moody's made it clear, while the US still boasts significant economic strength, it's no longer enough to offset the steady decline in fiscal health. The agency predicts that federal deficits could widen to almost 9% of GDP by 2035, up from 6.4% last year. The key drivers? Rising interest payments, entitlement spending, and what they describe as relatively low revenue generation. This downgrade marks the first time in US history that it does not hold a AAA credit rating from any of the three major agencies. S&P was the first to downgrade back in 2011, Fitch followed in 2023, and now, Moody's has joined them. Yesha Yadav, a professor at Vanderbilt Law School who studies the Treasury market, called this downgrade a brutal jolt to an already tense marketplace, and a wake-up call to policymakers. Yadav described it as a reality check on the US government's debt management strategy. Investors reacted immediately. Yields on US government bonds spiked, with the benchmark 10-year Treasury yield rising to 4.49%. Remember, when bond yields go up, prices go down, a signal that confidence is slipping. Andy Brenner, head of Nat Alliance Securities, wasn't surprised. He said, "The biggest problem now isn't tariffs, it's the lack of progress on deficit talks in Washington." According to him, this downgrade is adding even more pressure on US Treasuries. And it's not just the downgrade. Trump's budget and tax bill, famously dubbed the Big Beautiful Bill, failed to pass in the House of Representatives. Critics from within his own party argued it would add trillions more to the deficit. The bill aimed to extend Trump-era tax cuts, costing the US economy an estimated $4.2 trillion over the next decade, while trimming $663 billion from federal programs. The White House, however, dismissed the downgrade. Administration officials criticized Mark Zandi, Moody's chief economist, calling his analysis flawed and not to be taken seriously. But it's worth noting, Zandi wasn't even involved in this report. He works for Moody's Analytics, a separate division entirely. Financial experts weren't as dismissive. Stephen Gray of Gray Value Management called it a culmination of years of fiscal mismanagement, while Ann Rutledge, former senior analyst at Moody's, described it as a dire warning that has been long overdue. So what does this mean for America? Rising interest costs, tougher borrowing terms, and a deeper fiscal hole. With Moody's now stripping the US of its top credit rating, the question isn't just about how we got here, it's about where we go next. Will the US bounce back or continue down this path of financial instability? Only time will tell.